So hi everyone, my name is Cole Braithwaite. I am a commercial real estate agent here in the GTA and want to thank you for attending the Q2 2023 webinar. We're going to be covering all activity that has occurred over the last quarter and really the first half of this year in the GTA commercial real estate market. And I will take you through some of my predictions going forward and what you can anticipate and how you can take advantage of some of the opportunities that may be coming down the pipeline going forward. So what we will cover in this webinar is a couple things. Number one, I will go through the activity that we saw specifically in the retail market over the last quarter. I'll share with you just to start off some of the statistics and the activity numbers that we've been seeing. We will then jump into the industrial market and again share with you some statistics and the activity that we've also seen there to give you an idea of what's happening in that market. These are two areas of my specialty as well as residential land, but in this presentation we'll just focus on these two asset classes going forward. I will then answer the question of obviously where are interest rates going. This is on the minds of many of my clients that I talk to. Everyone is getting mixed messages through the media as well as activity that's been happening in the market and talking to other individuals. So I want to boil it down to where I see rates going and how you can prepare for that going forward. And then finally, what I will summarize it all as what it means for you. Whether you're a buyer, you're a seller, what does this current market situation and activity mean for you and how you can take advantage of the opportunities going forward. So we'll first jump into the retail market, and what I'm headlining this for the last quarter is called retail market stagnation. Essentially what we've seen over the last quarter is that retail sales volume has dropped off 80%. Now these, just to categorize it for you, these are properties over 10,000 square feet within the GTA. So I focus on a lot larger assets. I took out some of the smaller street front retail urban stuff that you may see downtown. So it's mainly, it is retail properties over 10,000 square feet. We saw a total of $50 million worth of sales occur in the quarter. That's significantly down, lowest really in the last 5 years, even below the pandemic. Just to give you an idea, last year in Q2 in 2022, we saw $258 million worth of transactions or sales volume. So we're off significantly in terms of the amount of deals. I will jump into a little bit later as to why I think this is happening and dive in a little bit deeper as to what these metrics are saying. If we just take a look now at the number of transactions, those have also dropped off significantly as well. We saw roughly down about 68% from Q2 last year, with only 7 transactions occurring in Q2. That just passed. That's down from 22 transactions to give you an idea that we saw last year. So significant drop off, and again, significantly less than even what we saw in the pandemic in 2020, where we had roughly about 9 deals that were completed in the quarter that matched that criteria. So definitely the volume of transactions as well as sales have diminished for the retail sector specifically. What we're finding on a quarter-over-quarter basis is that there is a bit of it's another drop off in terms of the activity. So again, we saw roughly 88% from Q1 of last year. What I want to share with you with these stats, and just so you can get a grasp and an understanding, is that typically a sales transaction is going to take anywhere from 4 to 6 months to complete. So anything that we're seeing completed in the current quarter typically went under contract 4 to 6 months prior to that. So you can assume that deals that we're seeing close in Q2 22 were usually started or agreed upon in Q4 of 2022, or even as late as Q3 in 2022. And we can see a steep drop off from last year because the majority of the transactions that occur in Q1 were done towards the end of last year, where the interest rates still had risen significantly, but there was still more hikes to go. And essentially what we're seeing is that how that has really taken the volume of transactions completely down. So that's down from $418 million worth of transactions in Q1, just to give you an idea. The number of deals that have occurred, again, have been on a steady slope and decline. over the last really 4 to 5 quarters. We've just seen a steady decline of the amount of deals. Like I mentioned, we were down to 7 last quarter, in Q2. Q1 we had 11, and it's just been declining from the peak where we can now essentially call it the peak of Q2 of 2022, where we saw, I think, around 22, 23 transactions occur, which ever since then, ever since they started raising the interest rates, that's when we saw a steady decline. Right now, the numbers and what I've calculated is that if we continue on this pace, the retail market will be on pace to do about $938 million worth of transactions. Just to give you an idea, that's 26% decrease from what we saw last year, where they did roughly over 1.1 million, 1.2 billion, in sales. And the reason why I think that this is occurring is twofold. One, I think buyers are still interested in the retail asset class, so by no means is it the death to retail or any change. But what's happening is that the interest rates are a lot more sensitive on the investment analysis when purchasing, and as a result, the numbers aren't penciling out as much. On the other side, the sellers that own many of these properties are well capitalized. So they are under no stress to sell the properties at a lower number than what their expectation was. And there are a lot of the time, in talking with a lot of my clients, they're willing to wait it out until the cycle comes back around, potentially if they don't achieve their numbers. And the reason being also, as well, is that we're seeing historical occupancy rates anywhere from 95 to about 100% of most retail assets, whether that's grocery anchored, whether that's strip retail. Their tenants are still occupying their properties. There's not a lot of vacancy available in the market, and as a result, vendors' cash flows are doing well. So if you haven't purchased really in the last 5 years, and you're not subject to the higher interest rates or higher debt levels, then chances are, you're in a good position to weather the storm going forward here, and if you don't achieve your numbers. We'll jump forward now into the industrial market, and what I'm calling this is really industrial market volatility. Now, don't be confused by the title, meaning what I'm sharing is that over the last, and we'll see over the next several charts, we'll see a fluctuation in the amount of transactions and activities. And again, the industrial market has pretty much been the darling of the GTA market over the last 5 years. We've just seen a hockey stick of the amount of transactions, the amount of pricing. Even on lease rates, we've seen it going through the roof. So now I think we're getting to a stabilized number, but we're still seeing strong demand. So to give you an idea, it's a completely different story from what we saw with retail. Even though the sales volume has decreased slightly from Q2 of last year, which we know was the peak and is the highest level, we're seeing it roughly about a 25% decrease in the amount of sales from what we saw last year. So $870 billion worth of transactions was completed in Q2. That's down from 1.1 billion that we saw in Q2 of 2022. So still doing well. In comparison, we are higher than any other previous year over the pandemic, 2021, even 2019. So really over the last 5 years, we're still at a peak, even though it's dropped slightly than what we saw last year. Again, I will preface that these are sites, or these are industrial buildings anywhere from 10,000 to 100,000 square feet. This is kind of what I target mainly in the mid-market segment. I've stripped out a lot of the larger stuff over 150, 250,000, where we still see a lot of transactions occurring with those, but vast majority of them happen between the 10,000 to 100,000 square feet, which I feel is most relevant for this conversation at least. If we take a look at the number of transactions occur, again, now the number of deals has decreased about 42%, which only equated to about 57 sales we saw past quarter, and in comparison to the 98 that we saw in Q2. What this typically means is not that two things are what I would take from it. Number one, we're seeing that the sales values are still quite high, even though we're having less transactions, which means prices are increasing to compensate for the less amount of deals. So we're seeing values increase within that segment. Number two, also what we can look at is that depending on the time of the availability of listings or opportunities will then dictate the fluctuation in the amount of sales. So it's not that there's not a demand, there's just less deals available for individuals to purchase. Mainly buyers in this segment are either are private capital or smaller investors, or we see who are really leading the market, really and driving it, are user operator business operators. Their businesses are doing so well that they're expanding on a lot of their building and requiring larger footprints. And anytime opportunities come available, they're jumping on it because they know that there's a restricted supply of opportunities and deals available for them to make work. So that's what I think is occurring with it. If we take a look at the quarter-over-quarter stats, this is the choppiness that I mentioned. Since the Q2 of 2022 till now, we can see the trend that starts at a peak, then dips, then increases again, then dips, and now we're on an increase in comparison to the previous quarter. And this really cements my thought on the amount of available listings. When there's listings occurring, then we'll see a lot of sales. When there are a low amount of listings, then the sales just decrease as a result. So the absorption for these types of properties and product is still quite there. So 85% increase in the amount of sales volume from last quarter. And in terms of the number of transactions, a 46% increase in the number of transactions from last quarter. So we saw 39 sales in Q1. Now we're up to 52, just to give you an example. So as long as there's more opportunities available, there's going to be more buyers, and I think that's going to continue to operate in the trend specifically for the industrial market. If we take a look at cap rates, and I got this chart from Altus, one of the recent reports, they just took a look at, and what I want to kind of draw your attention to is over the last roughly 20 years, we can chart the 10-year Canada benchmark Canada bond yield, quote unquote. We can look at the interest rate and how it's decreased over the time, but how there's a correlation with the cap rates and the interest rates. You can see some of the major asset classes of what they've chosen to kind of highlight. I believe this is Canada-wide, but nonetheless kind of gives you an idea. For office space, you're looking at around 6.5% cap rate as of Q2 22. So they typically tend to be the highest. In the opposite, the lowest cap rates we're seeing obviously is within the apartment markets. So even though the interest rates have risen, many of the asset classes are starting to see a little uptick in the cap rates. Apartments are really the only ones that haven't, and they seem to be quite stable, even though their financing expenses has increased, which has affected a bit of the market in terms of the amount of sales. But what I will say throughout all asset classes is overall the sales volume is slowing, so interest rates are having an effect on it, but values haven't decreased as much. We're just seeing vendors hold on a lot longer for a lot more of their unless they achieve their numbers, is what essentially is driving things. So which leads us to really the question that I get a lot from clients, and what I'm hearing from everyone is, where are interest rates going? Where are they today? What's going to be driving this, and how can I predict, or how can I make the right choices for myself and my business going forward in order to position ourselves, right? And this chart only shows really up until January, but we can see in comparison just the interest rate, the inflation rate, extremely high. Bank of Canada commensurately raised their rates to pull that back, which is the whole idea and goal behind everything. So how long will they last at these levels? So I've boiled it down to essentially three things, of which where I've heard this and got this from the Bank of Canada and their governor in his talks as to how he's making decisions as it relates to interest rate. And by understanding some of these 3 points, we can then get an idea of how we can predict and position ourselves going forward. So number one, obviously, is inflation. Inflation rates as of as of June or our previous month, July, we saw about a 2.8% inflation rate, which is down from what it was previously. So we're starting to see inflation roll over, which is good. The Bank of Canada mentioned their target rate is 2%. What I'm told is that there are some statistics that are going to be coming in over the next couple months as it relates to oil and the other factors that play into this inflation number, that we may still see an increase, or inflation still may be at an elevated level. But I think we're starting to see that we're having it under control. So one metric they're going to look at is how is inflation doing and how close is it to that 2% rate before they start thinking pausing rates, or before they start to decide, okay, when are we going to start to cut rates is number one. Number two, what they mentioned is unemployment. Currently, the Canada's unemployment rate is at 5.4%, so you can essentially call that full employment. Unfortunately, the way they look at things is that as long as employment is high, there is a propensity for businesses as well as individuals to then spend, which can then contribute to the higher inflation rate going forward. So what they unfortunately want to see is higher levels of unemployment and job loss in order to justify, or in order to pull back on inflation, and then in order to justify a reduction in the interest rate holding on that. So until we see this number start to tick up a little bit more, we're going to be in this environment, because the Bank of Canada is making the assessment that the market is actually stronger. The job market, the economy is a lot stronger than what it's performing as, and can handle these higher levels of interest rates based on the data going forward. The third thing that they mentioned is they're looking at the overheated activity in the residential housing market. I know we've had a historical influx of immigrants, which has been pushing up the demand for housing. We're running into a lot of the major cities a housing crisis, but from their standpoint, they're seeing it as the prices is just increasing too quickly, or faster than what it should be. So they're looking to see, okay, can we see data that suggests that the transaction volumes are slowing down, or that prices are pulling back? And then we can make the inference that we're hitting our goals in terms of what the interest rates were supposed to do. And essentially, if we can boil all three of these factors in together, that's how we can then determine. So when you're looking at projecting or forecasting going forward, you can assume any one of these things that are occurring, or can see some insight into that. That'll give you an idea as to, from my estimation, where these interest rates are going to continue to go. So how will this affect the market? And ultimately, I boil it down really to two things. Number one, it's going to slow the market activity. We're already seeing it in terms of specifically within retail, but many asset classes overall are slowing down, meaning that the higher interest rates are making it very difficult to finance properties, or make investments, make logical assessment of investments when you're paying, we know that the prime rates are at a low 7%, 7.25% interest rate when you're paying a 5% cap rate for a property. The numbers don't seem to make sense a lot of the time, and you're not getting that positive leverage. So there is a bifurcation between the price point of the assets that you're purchasing. The higher the level they are, the ones above 10 million, 15 million, where financing is going to be a major issue in terms of getting the deal done. That's where we're going to see a little bit of a slowdown, as opposed to the smaller assets, let's say sub 5 million, where many investors have large capital reserves that they can put down, or large equity positions that they can put down to adjust the debt level numbers to allow things to make sense. So what I'm seeing is it will also be asset specific. Some assets are a lot more sensitive to the inflation, not the inflation, but the interest rates increasing than others. Overall, they all are, but mainly, example, residential development land, developers purchasing land and purchasing property for that, their margins are a lot slimmer, so they're going to be a lot more affected. Hotels, we know, on a short-term basis, they are, because of the short-term lease term between the occupants, they are more sensitive to the fluctuations in rates, and we're seeing that really throughout all of them. Retail and office, I think, are going to be some of the more sensitive ones as it relates to this presentation. Industrial is still going to be strong, but it really depends on whether businesses and owner-occupiers can continue to handle at these higher rates. And I think we're really getting to the tail end of their ability to be able to do so, in my understanding. So when will they begin to cut? So based on the three metrics that I said to look at, my thought is, first, in order for them to decide to start cutting, the economy must break, and that this is unfortunate. What I've noticed with the Bank of Canada in the past and how they make decisions is that they're data dependent. Now, how this data is collected, there's a time lag from when they decide to make a decision than what's actually happening in reality, just based on the data is past looking. So as a result, they're going to be late to the curve before they cut. So we'll probably see a break in the economy first, whether that's higher unemployment or businesses beginning to struggle before they decide that they're going to cut rates to compensate for that. So based on based on watching how they operate, I think that's how that's most likely going to play out. What I'm advising a lot of my clients is really just anticipate higher rates or rates at these higher levels for longer than what you expect. I think the days of low interest rates, 2-3%, I think are gone. I think we're probably, when it's all said and done, probably in a 5.5% prime interest rate, prime rate sort of economy or sort of cycle going forward. I think inflation is going to play a part over the next decade in terms of affecting the markets going forward. And interest rates, I think, at these levels are here to stay. Now, what I will preface is that historically at around 5%, it's still historically lower than what we've ever seen in the past. But I don't think what we saw previously at pre-pandemic, I don't think we'll get back to those days with it. So when you are underwriting or making decisions on some of the assets and the purchases, keep that in mind when projecting out. It's better to project out at these higher, make offers or make judgments based on these interest rates remaining higher for longer than it is for you hoping that there's going to be a cut some point in the future, in the near future, that will change your investment thesis on how things operate. So that's kind of how I'm looking at it going forward. So then the ultimate question then becomes, okay, well then what does this mean for you? And I've broken it down into two categories depending on if you're a buyer or if you're a seller. So if you're a buyer, number one, I would still be aggressive for quality. If there is quality assets, well-positioned locations, well-tenanted assets that are come available in the market, they are still getting high amounts of interest. They're still getting competitive bids. There's still a strong demand for buyers to purchase these. You should be looking at acquiring these types of assets that are going to do well over the long term and that also don't come available that frequently. As a result, there's going to continue to be demand for it, and looking at long-term future potential, I don't think you can go wrong with still being aggressive for quality assets. The next thing I would look at is get ahead with your financing. Financing and the debt markets are continuing to be a challenge really in getting a lot of deals done. In today's market, lenders are starting to get a lot tighter or a lot more stringent on their requirements. So it's important you get ahead of that, whether that's you arranging all your financing up front or having all those conversations with your lenders prior to. This will help you when you go into the offer process, where you're able to move faster on your due diligence period, which is attractive for sellers, knowing that you're not going to need financing or you're not going to take long to underwrite the deal or to underwrite your financing for the deal. That this is what could be very a strong incentive for you in purchasing and being and navigating this market specifically. And the final point is just be patient. I think there are going to be deals that are going to come available. I think there are going to be some distressed owners that are pressed because they have higher or higher debt levels, or it may not be even beyond the specific properties that they have high debt levels on, but other assets or other portions of their portfolio that may be struggling due to these rates, and then they're forced to liquidate in order to cover any losses. So be patient. There will be opportunities, there will be deals with it. Just pick and choose, pick and choose and get an understanding of the markets and where the values are, so that when opportunities do come available, you can jump on them quickly, which makes the whole process a lot easier. Because bear in mind, there's outside of yourself, there's still going to be others that are going to be opportunistically looking aggressively for deals too. You want to outcompete them and outbeat them, and this is how you do so. So if we move on to sellers, what you can do is, if you're selling an asset in today's market, the key is to price it attractively. I'll give you an example of a sale we just recently did last month. It's an industrial building within Scarborough. We consulted with the owner on pricing the asset in a competitive manner, as opposed to pricing it a little bit higher and hoping for bids to come in lower. By doing so, we were able to attract 6 offers roughly within 3 days, and 2 of which were over the asking price. I don't think we would be able to achieve something like that if we had priced it really high and hoped that the buyers would have came in at those numbers. The reason why it mattered was because in this environment, we were able to put a competitive situation together, which allowed buyers to compete against each other to then pay the highest price for it. That's what I'm finding is the only way really you can get your numbers or get the market to pay the highest expectations when there's competitive bids. If there's only one buyer coming to the table, chances are it's going to be hard for you to push him to get to the highest number unless he knows he's competing with somebody else that he may lose out on. So that's something to think about and what's been effective for us, especially in this market, is the pricing it attractively. The way buyers are today, if they see the numbers that are way too high, or it seems that it looks based on the price or the valuation that the vendor is not in line with what the current market is, buyers are just going to move on and not look at it, and your property is going to sit, and we're going to start to see more and more listings sit on the market that are not priced attractively for buyers. Number 2, what I would say is work with buyers. Buyers, like I mentioned before, financing is becoming a lot more of an issue, but due diligence can become a little bit more challenging as they move through the process. So work with them. Have all your ducks in a row. Try to work with them on a deal by deal basis. Let's say, for example, you're able to get them to agree to your pricing terms. Maybe you're able to work with them on terms and conditions of closing dates or extending conditional periods, just so that they're accommodated to make things easier. The easier you can make it for the buyer to make their decision to move through the process, the better it's going to be for you to get deals done. The third thing what I want to suggest is make the process easy for them. This is similar to the second point, but in a sense, you want to have all your environmentals complete before you go to market. Have all your leases in place, all your contracts, all the due diligence documents that a buyer is going to require. Ensure that you have that up front. The reason being is that you can help them make their decisions a lot quicker and speed up the process instead of having them bogged down in long due diligence cycles. The way this market is, and specifically, and we ran into this a lot last year as they were raising interest rates, is that the longer the due diligence periods, the longer you run into the chances of interest rates rising during that period and then affecting the ability to close the deal. Buyers may, and I ran into this, a buyer made an agreement or agreed to a deal at a particular interest rate, made an offer, but the 90 days, 120 days it took for them to go through the due diligence period and then close, he was completely in a different interest rate environment by that time. So in order to save deals and to ensure you can continuously get the highest price, shorten that period as best as possible by providing them with everything that they need up front, so that either A, they decide, look, this asset is for me, I did my analysis, it makes sense, or that it's not, and we can go right back out to the market quickly to the next best buyer that can move forward with things in a process. So that's kind of what I'm advising that's been effective, and we've seen it played out with a lot of examples that we've worked with our clients most recently. So what I want to share with you now is just a value opportunity that we do have available in the market. If you are looking for retail assets specifically and are open to opportunities with second floor residential with a value add component, this opportunity can play well. It's located in downtown Cambridge. We've just come to market with it. It's roughly about 7,500 square feet. And we're looking just under we're asking about $2 million for it, which is on a per square foot basis below replacement cost. The opportunity here for you is you can reposition the second floor apartments into two of the apartments upstairs are rented, but you can reposition some of the units into higher quality apartments, which the area is screaming for demand for. There's not a lot available in terms of rentals. So if this was able to be repositioned, you should be able to achieve top of market rents and locations. The building itself has its own parking and dedicated parking, as well as you can reposition a lot of the ground floor tenants. Tenants are on month-to-month leases, so there's flexibility there. All are willing to stay on longer, so there's ways in which we can structure it for you to kind of maximize the value out of that. So I just wanted to share an opportunity, one of the deals that we have right now that may make sense for you and something that you can consider. That's really just the end of the presentation. If you have any questions or anything specific, please let me know as it relates specifically to your assets or any situations. If you're open to any off-market deals or anything specific, let me know. We have other opportunities available. just depending on, client's basis of what they're looking for, we can present those opportunities and deals to you. So I hope this was insightful and I was able to kind of give you an idea and some actionable steps you can utilize going forward. And really, until next time, I will be doing these webinars each quarter. The next one I'm anticipating is probably in November, once all the data is out for Q3, and give you some more insights going forward to that. So I look forward to being in touch with you and available anytime for any questions going forward. So thanks a lot.